Good morning, everyone. We are Group 13, and we'd like to share with you a story about beating the odds. Now, who wants to be a billionaire? Well, Padram does. Padram has been investing for a couple of years now and has some money saved up in his investment accounts. However, his student loan payments have been increasing, and he feels like he could do a little bit better. So what does he do? He starts looking into the option market where the risks are high, but the returns are also high. And as an MSBA candidate, he wants to use his analytical skills to make more data-driven, informed decisions. And after doing some research in the market, he feels like there are some weaknesses in the traditional methods of option evaluation. So he decides to see if he could predict the value of a European call option and classify it in comparison to the black-scholes model that has been traditionally used by many market participants. By using machine learning to gain an advantage in identifying the mispricings in the market. So if he could predict the value, then he could see and decide whether he could sell the option before the maturity date to gain a profit. And as we continue on with our presentation, we discuss his exploratory data analysis, his evaluation of the regression and classification algorithms, his best model selection, and the predictions he made on the test data, as well as solidifying everything in our conclusion. Passing it off to Nelly.
First, Padram explored and preprocessed his data. He made sure there were no null values. He removed unnecessary columns, and from the training dataset, he extracted summary statistics. He saw potential skewness and outliers on the value and tau variables, and he visually confirmed this by creating box plots. However, since Padram did not have any context on the data and justifications for the outliers, he decided to keep those data points. In fact, those outliers could contain valuable information. Furthermore, Padram was curious to check whether his data was balanced. As seen here, the underclassification value occurs 3 times that of the overclassification value. And therefore, to address this, when running classification models, Padram will use stratified k-fold cross-validation. This will ensure that the proportion of the minority and majority classes is maintained across each of the folds. Lastly, to wrap up his EDA analysis, Padram generated a correlation matrix. He noticed a strong negative relationship between current option value and strike price, and confirmed this using a scatter plot. The relationship makes sense because a lower strike price for call options increases the likelihood that such an option is in the money, increasing its current value. There was also a strong negative relationship between current asset value and the annual risk-free interest rate. And this also makes sense. If the annual risk-free interest rate increases, stocks, which are a risky asset class, become less attractive, and we would expect their value to decrease.
Now, when it came to model selection, Pedram wondered if best subset selection was necessary before running the model algorithms. But after he thought about it, he decided not to undertake best subset selection for 2 reasons. First, we only have 4 predictors, and second, the model performs very well using random forest algorithms. For each of the regression and classification modeling techniques, Pedram performed 10-fold cross-validation and hypertuned the parameters specific to those models. For instance, this included hypertuning the number of neighbors in KNN, tweaking the minimum number of samples in each leaf in the decision tree algorithm, and hypertuning the number of trees to be built in random forest models. For classification, he ensured to use stratified folds. Also for lasso and ridge regression, as per best practices, he ensured to first standardize and then hypertune the alpha parameter prior to fitting the models and evaluating their performance. Now, to evaluate the model performance, Pedram utilized mean R-squared for the regression and mean classification error for classification. And now, to conclude, the final models selected by Pedram were support vector machine regression because of its high R-squared and XGBoost classification, which during training gave the lowest mean classification error.
As for using the models to make predictions, I use support vector machine regression and KG-boost classification on the test data to make my predictions on the 2 tasks at hand, which are 1, a regression to predict the current option value, and 2, a classification to predict whether the black-scholes formula over or underestimates the option value. Now, as for the business understanding, I believe that I have found the key in becoming a billionaire. I had mined a pot of gold. Machine learning algorithms outperformed by a great margin the classical approaches such as black-scholes for the options valuation problem. Now, with my entrepreneurial mindset, wanted to take this one step further. I wanted to license out my ML models to individuals involved in options trading, including traders, quant analysts, portfolio managers, risk managers, among others, to also use these state-of-the-art models for their work. Now, upon talking to various field experts, 4 questions about the approach taken, the models themselves, and the models' applicability came up over and over again. The first one being, in both prediction problems, is prediction accuracy or interpretation more important, and why? Now, I said that prediction accuracy is more important for both the regression and the classification due to the high velocity and volume of financial data. Now, being able to accurately predict in real time is more valuable than having a highly interpretable model. In addition, given we are only looking at 4 predictors, our model is simple enough to facilitate interpretation. Now, the second question is, why would ML models outperform black-scholes in terms of predicting option values? Now, the black-scholes model is rigid and relies on strict assumptions, which cannot be held in practical real-life settings. Machine learning models, on the other hand, are more flexible and can automatically learn complex non-linear relationships between the predictor variables and the option value from the data itself. This flexibility allows ML models to potentially capture more intricate dynamics and provide more accurate predictions.
Another question regarded the choice of independent variables, current asset values, strike price, risk-free rate, and the time to maturity, and whether there should be some variable selection. So let's discuss the rationale behind including these features. Both current asset value and strike price are indispensable for determining an option's value. As a European call option provides you with the right to purchase the underlying stock at the contract's expiration, a rising value of the underlying would increase the option value, as an investor could now purchase the stock below the market price. Similarly, the strike price determines the price at which one can buy the stock when the options contract is executed. Together with the current asset value, the strike price therefore provides us with information on whether the option is in the money. The risk-free rate matters due to its impact on the relative attractiveness of different securities. As explained earlier, stocks become less attractive when one can make more profitable, risk-free investments when rates rise. The interest you can earn at higher rates makes the opportunity cost of buying the stock less attractive versus buying the call options. Lastly, the time to maturity matters. The longer the time to maturity, the more time for a change in the underlying price that could put the option in the money. Now, does this mean Padram can use the trained model to predict option values for individual stocks like Tesla? Now, without additional validation, Padram would not feel comfortable doing so. This is because this model was trained on S&P 500 option data, a market index which may not fully capture the unique dynamics and risks associated with an individual stock like Tesla that only makes up a small part of the index. In fact, there are several factors that could impact the applicability of the model. Number 1, Tesla's volatility and price movements may differ substantially from the broad market index. And 2, the model may not account for company-specific events, news, or other external factors that could strongly influence Tesla's stock price. Therefore, before deploying the model for Tesla predictions, Padram would need to first test its performance on a holdout dataset containing Tesla option data. If the model generalizes well, then it could potentially be used with some added monitoring and adjustments. However, if performance suffers, then the model may need to be retrained specifically on Tesla data to ensure accurate and reliable predictions. Now, thank you so much for listening to Padram's story. May you all find your pot of gold and beat the odds.